Okay, so the first illustration we're going to walk you through is short exercise 11-1, and then we're going to look at 11-2 as well. So starting with 11-1, it's simply to state how to compute the standard cost of direct materials. And for this problem, we've got a company that's making milk chocolate fudge. It says that they sell their fudge to local retailers, and then they do this, a unit of fudge. Here's the key, is a 10-pound batch. So they sell everything in 10-pound batches. So all the standard information is given right here. It says the standard quantities of ingredients for a batch include, and here's what they give you. They give you 7 cups of sugar. They give you 23 ounces of chocolate chips. They give you 16 ounces of butter and then 18 ounces of evaporated milk. So I wrote these numbers off to the side. So what you're going to have to do is to come up with the standard cost is to multiply by the standard price. And they give you the standard price right starting in this sentence. So for the sugar, it's 17 cents. So you'd multiply 7 times 17 cents. For the chocolate chips, it's 18 cents. So it's going to be 23 multiplied by 18. For the butter, it's 11 cents per ounce. So you'd multiply that one by 11 cents. And then finally for the evaporated milk, it's going to be 14 cents. You'd multiply that out. So once you multiply all of these standards together, you're going to add them up, and that would be the standard cost for the direct materials. Now, again, we'll show you this exact answer on the next slide, but I wanted to walk you through the basics of what you're looking for. Now, the same thing on 11-2 to get the standard cost of direct labor. Again, they produce fudge. Here's the same information as 10-pound batches. Here's the key. It says each batch takes its 0.26 hours of direct labor time, and this allows for all sorts of downtime cleanup. It says that they pay them at about $17.50 per hour. The standard labor cost will simply be to take that 0.26, and you're going to multiply that by the standard labor rate of $17.50. That's going to give you your standard labor cost. So again, I'll give you the exact numbers again on the next slide. So again, I walked you through both of these. This is the answer to short exercise 11-1. Notice here's all those quantities that I gave you in the previous one, and all you're doing is you're just multiplying by the standard price which was given, and then once you multiplied those all out, you get the standard cost for each of the raw materials. You add those up and you get, in this case, it's going to be $9.61 is going to be the standard cost for the direct materials. On short exercise 11-2, again, I showed you this on the previous slide. You simply take the 0.26 hours, you multiply by the standard wage rate, you'd get the standard labor cost is right at $4.55 of direct labor cost. In this case, it's per batch. Okay, so the next one I want to work with you on is to show you short exercise 11-3. This is going to be to calculate your direct material variances. In this case, it's when the quantity purchased is going to be the same as the quantity used. So in this case, they produce large planters to be used in landscaping projects. They tell you that the raw material here is going to be a special earth clay is used. The standard quantity of clay used that they give you is for each planter is 24 pounds. It says they use a standard cost of $2 per pound. It then tells you that they produce 3,125 planters, and that they also tell you that they had purchased 78,125 pounds of clay. So then, and this is a total cost of 150,000. What they want is the price variance and the quantity variance. So remember, the price variance is based on what you purchased, and they told you that they purchased 78,125 pounds. Remember, the quantity variance is based on what is used. In this problem, they're basically telling you that what you purchased is what you use. So you're going to use the same actual quantities for both of those variances. Now, one thing you will have to do when you do the price variance is you're going to have to take that 150,000 and you're going to divide that by what you purchased, which is 78,125. Because again, what you want is you want a price per unit. So once you've divided that out, you'll compare that to the standard cost. The standard cost is $2. And remember, you want to pay less than $2 per pound. And if you did, you'll get a good favorable price variance. And then again, on the quantity variance, the extra calculation you're going to have to do is you're going to have to take what you produced, which is 3,125. And they tell you, if you go back up to the top here, they should tell you what the standard is to make a pound of clay. And it says right here, the standard quantity of clay used for each planter is 24 pounds. So what you'll have to do is you'll have to take that 3125 and multiply that. That's the standard quantity allowed. Once you do that, that's going to be essentially the number you're going to compare to the 78,125. That essentially is the standard quantity that you should have used to make or to produce 3,125 planters. So again, we'll show you the exact numbers in the next slide. So again, to get the price variance, notice this $1.92. I told you in the previous slide, that's where you had to take the actual cost, which was 150,000, and they would have divided by 78,125. So you've got the actual price. The standard price was given at $2. Notice you are paying less than the standard price by 8 cents. That is good. That's favorable. You multiply by the actual quantity purchased, which is 78,125. So you get a favorable price variance. Now regarding the usage, so again, you compare what you used, which in this case is exactly what you purchased. But remember, it said that they had produced 3,125. You're going to have to multiply that number by that 24. That's what would give you the 75,000. And remember, you want the actual used to be less. It's not. So the difference is 3,125. That's going to be unfavorable. Multiply that by the standard price of $2. You'd get 6,250 unfavorable quantity variance. Okay, so this illustration is going to be for short exercise 11-4. And you'll note this is going to be for direct material variances when the quantity purchased is going to be different than the quantity that was used. So in this case, the direct material we're going to be looking at is a special resin. You'll note that there's a special resin that's used to make these planters. That's going to be the material. They give you that the standard quantity of resin used for each boulder is 5 pounds. So you'll need that number to calculate to get that standard quantity allowed. They give you that the standard price is $2 per pound. So that's the number you're going to use when you look at the price variance. They told you that they produced 2,650 boulders, guys. That's the number, the 2,650. That's the number you're going to multiply by 5 to get that standard quantity allowed number. They tell you that in that month of June that they had purchased 12,500 pounds at a total cost of $26,000. So one of the things you're going to want to do is you're going to want to take the $26,000 and you want to divide that by the 12,500. That's going to give you your actual price. Notice that it says, so once you get that, you'll compare that with that standard price of $2. And then the last thing, just to kind of make a note of, it says that a total of 12,250 pounds were used. Notice that what they used is different than what they purchased. What they used is what you're going to be using when you do the quantity variance. Now, on the next slide, we'll walk you through the exact answers to this. All right, so notice when you look at the price variance, remember I said you had to divide to get that actual price. So the actual price turns out to be right at 208. Again, go back to the previous slide and look at the purchase price divided by the amount that you purchased. The standard price was $2. In this case, you paid more than the standard, that by 8 cents. That's not good. Again, they actually purchased 12,500. You multiply that out, you're going to get an unfavorable price variance. Now, on the usage, notice they tell you that they used 12,250. This number right here, that's where again you have to take the number that you actually produced and you'll multiply that by that standard quantity number that they gave you. Again, I showed you this in the previous slide, but it's what you produce times the standard input. That tells you the standard quantity. In this case, you did better than the standard quantity by 1,000 pounds. Multiply that by the standard price. That gives you a $2,000 favorable quantity variance. Okay, the next one we're going to look at is short exercise 11-5, and we're going to look at how to calculate the direct labor variances. So in this problem, it's an oil change problem. They tell you that the standard wage rate is about $20 per hour. They also tell you that they have developed a standard that takes about 21 minutes to do an oil change. 21 minutes, if you take 21 and divide that by 60 minutes, there's where they get the 0.35 hours. It says that in July, 800 oil changes were performed. Think of this 800 as kind of like your production. They also tell you how many hours the oil technicians worked, which was 260, and this is what you actually pay them. So On the rate variance, they want to basically compare what you actually paid versus what the standard price is. And then on the efficiency, you want to compare how many hours they worked versus how many hours you think they should have worked. Now, the one extra calculation you're going to have to do, at least in part 2, is when you do the efficiency variance. When they performed 800 oil changes, you're going to have to multiply that by 0.35 hours. That's going to give you your standard quantity number that you're going to compare the actual hours to. And again, we'll show you the exact numbers on the next slide. Okay, so if you look at the solution for short exercise 11-5, they kind of put it in a different order. They're actually showing the efficiency variance first, and then they're showing the rate variance second. No big deal. So if you looked at the efficiency variance, they gave you the actual labor hours. I told you in the previous slide that you have to take the total number of oil changes and multiply that number by 0.35. That gives you the standard number, the standard quantity. Because the actual is less than the standard, that's good, but the difference is 20 times the standard labor rate of 20 gives you a favorable efficiency variance. When you look at the rate variance, again, the actual labor rate was about 23 bucks. You spent more than the standard, that's not good, that's the $3 difference, times the actual labor hours, that gives you an unfavorable rate variance of $780. All right, the next exercise I'm going to walk you through is short exercise 11-7. This is going to be on how to calculate variable overhead variances. And so what we have here is we have the Simmons Industries. Tells you that they produced 3,000 tables, so we're going to need that production number for our standard quantity. It tells you that the standard variable overhead rate is $18. They gave you that. They also tell you that each table requires 0.5 machine hours, and then they give you that the actual machine hours used were 1,550, and they also give you the actual variable overhead rate to be $17 per machine hour. So they want to get the rate variance and the efficiency variance. So remember, with the rate variance, all you're going to be doing is comparing what you actually paid versus the standard. So you're going to be comparing the $17 to the $18. Again, this one looks good because you paid less than the standard. So, and again, in a moment, I'll walk you through the next slide to get you the actual numbers. And on the efficiency variance, again, what you'll want to do is you want to take the 3,000 units produced and multiply that by 0.5 machine hours. That's going to give you 1,500. What that number is going to do, that's what you think you should have used when they actually produced 3,000. You note that they actually used 1,550, and you'll notice that's the actual quantity used. That is not less than the standard. That's not good. You'll take that difference, you'll multiply that by the standard 18 bucks. That'll give you your efficiency variance. Again, I'll walk you through the numbers on the next slide. So again, notice on the rate variance, all you do is compare the actual rate to the standard rate. Notice you paid less than the standard by $1. That's favorable. Multiply that by the actual quantity of 1,550. You get a variable overhead rate variance, again, of 1,550, favorable. For the efficiency variance, again, you want to take the actual hours, which was 1,550. This must be a typo in the solution because the problem is it's actually 0.5 hours, not 0.25. So if you take 3,000 times 0.5, that gives you the standard of 1,500. Again, this is not good. You did not beat the standard. The difference is 50 hours. Multiply that by the standard rate. That gives you an unfavorable efficiency variance. All right, the next exercise we're going to look at is for the fixed overhead variances. This is short exercise 11-8. And in this problem, Bentley Manufacturing produces premium doghouses. It says that each doghouse requires 1 hour of machine time for its elaborate trim and finishing. It says for the current year, they have a predetermined fixed overhead rate is $21. They also tell you the budgeted fixed overhead is $14,000. They produced 1,000 doghouses, and the actual fixed cost, overhead costs, were $17,000. So they want, number one, to calculate the fixed overhead budget variance. That's the pretty simple one. You just compare the actual cost to the budgeted cost. And then on the fixed volume variance, we'll do a calculation where we're going to take the $21, which is that fixed overhead rate, and we're going to multiply that by what they produce. It's going to give us our standard input to look at the volume, and we'll compare that to the budget, and then that'll be the fixed volume variance. Again, we'll look at these on the next slide. So now, again, this is for the solution for short exercise 11-8. So the first one, to get the budget variance, all you do is compare the actual fixed overhead. They gave this to you at 17,000. The budgeted number, they gave that to you, which is 14. You spent more than the budget, 3,000. Unfavorable is your answer. On part 2, for your volume variance, again, in this case, you compare the budgeted fixed overhead, which was given. The standard allocated is where you took that standard overhead rate, fixed overhead rate, which was $21. You multiply that by the production. That's where they got that 21,000. And in this case, because you're less than the standard allocated, it means you're more efficient, your volume's good. That's going to be a $7,000 favorable variance. All right, I'm going to give you another example illustration on direct materials. This is exercise 11-18. We're going to be doing both the price and the quantity, and then talk a little bit about what could be causing any sort of variance here. So again, look at the problem. It says this is a collegiate ring. They produce class rings. In terms of direct materials, it's going to be the standard is 9 grams per ring, so we'll need that number depending on what they produced. The special alloy has a standard cost of $63.70 per gram. It says in the past month they purchased 9,400 at a total cost of $596.9. And then notice this is a total of 9,200 grams were used last month. So that'll be for the quantity variance. And then notice the production number, which is 1,000 rings. We'll need that to get the standard quantity of input. So again, this 9 grams up here, we'll end up multiplying that by 1,000. That's going to give you the standard quantity. Now, one more calculation you'll have to do is if you go back and find out this actual price, which was $596,900, you want to divide by what you purchased. And so if you divide that by the 9,400, that's going to give you your actual price purchased. You're going to compare that to the standard price to see how well you spent. So again, so part 1, requirements are 1, they want the actual cost per gram. Again, that's what you're going to do right here. You're going to divide by what you purchased. And then we'll do the price variance and the quantity variance, and then discuss what could cause any variances that we're going to come up with. So again, per requirement 1, to get the actual cost, this is what you actually paid. They gave you this number. This is what you purchased. So the actual price that you paid is $63.50 per gram. You compare that actual price to the standard price given, which was $63.70. That's good. You did better than standard by 20 cents. You multiply by what you actually purchased. You're going to get a favorable price variance of $1,880. Favorable. Now, in terms of quantity variance, they used 9,200 to get this number. This is where they took that 1,000 and multiplied by 9. So you got the standard quantity. Notice in this case, you used more than the standard input. That's not good. The difference is 200. You multiply that by the standard price, which is $63.70. That gives you an unfavorable quantity variance of $12,740. All right, the last one I'm going to walk you through is another direct labor variance problem. This is exercise 11-20A. In this case, it's a tax service. They prepare tax returns. They tell you that the standard in terms of direct labor time spent on each return is 5 hours, so that's your standard input. The direct labor standard wage rate is about $13.50 per hour, so that's another standard. They tell you how many hours were used to prepare 500 returns. Think of the 500 as like your production number, and they gave you total wages of $34,580. Requirements are, part 1, what's the actual labor rate per hour paid? So in that case, you'll have to take the $34,580 and divide that by the actual hours of 2470. That's going to give you what you actually paid. You'll then compare that to the $13.50 just to see how well you spent your money. That'll give you the rate variance. On the efficiency variance, again, what you'll need is for the 500 tax returns, you're going to multiply that by 5. Guys, that's going to be your standard quantity allowed input, which in this case is going to give you right at 2,500 hours. You'll see that again in the next slide. You'll see how many hours were worked. You want to beat the 2,500. It's looking good at this point. Looks like that's going to be a favorable efficiency variance. But again, I'll walk you through the exact calculations on the next slide. So notice part 1, I already kind of showed you where to get the numbers. You just take what you paid, divide by the actual hour. So the actual rate is $14 per hour. You compare that to the standard rate, the standard price, which was given at $13.50. Notice you're over by 50 cents. That's not good. Multiply that by the actual labor hours used, which was 2470. you get an unfavorable rate variance. So remember, you always want to be better or less than the standard for it to be favorable. Now, for the efficiency variance, again, they gave you this number, the 2,500. Remember, that's where you had to multiply the number of tax returns, which was 500, multiply that by 5. There's where they're getting the 2,500. Notice in this case, they were efficient. They did work better than the standard. They beat the standard by 30 hours times that standard rate of 1,350 gives you a favorable efficiency variance of $405.